All right, so today we're sitting here with Jesse Greeter. He runs a private equity company. If you don't know what that is, he essentially invests, buys, and sells private companies. He used to do stock market analysis and high-end commercial real estate, but today we are going to be learning fundamental analysis from him. He essentially took a business from 0 to 25 million AUM in about 2 years and has bought or sold an individual company every month for the past 12 months. And when was the last time you did stock screening, though, Jesse?
Uh, I haven't done stock screening like in a full depth analysis for probably over a year, maybe two.
Okay. Well, today we're just going to be going over the screening process of fundamental analysis. We won't get into analyzing the individual companies in this video, but we are going to sort and find potentially good companies to invest in. Okay, so I'm going to go ahead and share my screen. And I started off with the TradingView stock screener. Right now, we just have PE ratio and earnings per share. We're going to walk through the different criteria that Jesse typically looks for in a good company. And actually, let's start with earnings per share. You said you don't really like EPS, right?
Correct.
Why is that?
Well, earnings per share is it's the profitability of the company divided by the total shares outstanding, and there's definitely ways of manipulating that for it to look better by bringing outstanding shares back into treasury stock, purchasing stock back, and really messing with the number of shares that are issued altogether, because there are companies that do well, you've heard of stock splits, or they sell more shares out in the market, and the more shares that are out, the lower the earnings per share is going to be. So I typically like to see the aggregate whole of the profitability of the company. The earnings per share, to me, does not really matter all that much.
Okay, so they can basically buy or sell stocks right before their quarterly reports and then rebuy them or resell them afterwards to temporarily boost it.
Well, I don't know the rules governed by them of if they can or cannot do that, but especially right before earnings. But there's all sorts of different factors that would go into changing the EPS number. So looking at analyzing the financial statements and looking at it as a whole is going to be a lot better for you than using a function like EPS. And I guess the best thing about doing that is trying to compare similar companies to each other. But even then, it isn't a very strong indicator of anything, really.
Okay. All right. Well, I'm going to remove the EPS and back to, I guess, starting with comparing individual companies to each other. I know it's always good to start with a specific sector or a specific industry, so that way you're comparing companies that are similar to each other. So let's start with a sector. So I've seen energy's been doing really good over the past year. Do you have an opinion on that? Do you think they're going to continue to go well? I know industrials is also a sector that's looking to be potentially pretty profitable.
I mean, hard to say. I think energy could be pretty good, but as you've seen with like the COVID-19 shutdowns, where basically like oil production was cut off and no one was driving and it was utilizing, and the price per barrel dropped significantly, although it was only temporary. I'd say in the short term, it's looking good. It would depend as well on, what's happening in the markets, like California changed like their laws to like outlaw all petroleum ran cars over the next 10 years, and everything's going full electric.
I heard about that.
But there's like, factors like that. But I think oil is still going to be used in producing energy that people are going to use to charge their cars and stuff anyway. So
let's do industrials, because most of the companies that you've been buying and selling private equity have been industrial. So it's relatable, at least.
Yeah.
So market cap, let's start with that. I typically used to screen with at least like over 2 billion, but what's the lowest end that you would screen for?
About 500 million.
500 million. Okay. All right. So that's the basics then. Where do we start from there? Do you like to start with debt to equity or what?
Well, typically I look for I do price to earnings is an important one that I always go to. And I try to, if possible, after some of the rallies we've seen, but with some of the market tanking or going down over the past few months, maybe easier to find, but a PE ratio um less than 15.
Less than 15, below 15. Okay. We've already got it pretty narrow.
Yeah, I see that. Next would be current ratio.
Okay. So what's current ratio?
Current ratio is a financial ratio um, that looks at your current assets compared to your current liabilities. So it is current assets divided by current liabilities. So basically saying, like, if you had a 1.5 current ratio, it means that for every $1.50 you owe in like your current assets or your working capital, you owe back. Um, I'm sorry, I just lost my train of thought there.
Higher ratio is better because right because essentially it's your short term 1 year debt. Is that right?
Yeah. I said it backwards. That's what confused me. So for every dollar that you owe in your current liabilities, which is money that you owe to someone else, you keep $1.50. You have $1.50 for every dollar that
Okay.
you owe.
So if you
So
have if
you
you
like you cover your liabilities. Um, like if you were to liquidate everything, you would have something left over if you had to pay off everything.
Okay, so this Snap-on Incorporation, they have a 3.21 current ratio, which means they have $3 to every $1 they owe, versus Northrop Grumman, who has only a 1.06. So they barely have any. They basically have a 1-to-1 ratio to cover their debts, right?
Yeah, yeah, and companies that are less than one can be, depending on what sector it is, but normally it means that they could be in a lot of trouble.
Okay. What kind of current ratio do you typically look for?
1.5 or higher.
1.5. All right, I'm gonna jump the PE ratio up just a little bit, just so we can have. We'll drop it back down to 15 afterwards, but just to have some more companies to compare from. Um,
Yeah.
okay, so what's the next thing you look at?
Typically I'd like to see the return on equity over 8%.
Okay, now what's the difference between ROE, ROA, and ROI? What's uh, yeah, just explain the differences between equity versus assets versus capital.
Yeah, return on equity shows like it's the net income of the company divided by the equity portion. So for a public company like this, those are the money raised by stocks, ownership in the company. So what it really does is it finds how well management is, operating the company and making it profitable based on the amount of equity that they put in. And that's a number that's extremely important, if you're investing in any sort of company, is knowing, um, are they generating profits on the money that is being invested into the company? Whereas return on assets is an efficiency ratio that it's your net income divided by your total assets. So what that's trying to determine is, are you utilizing your assets efficiently enough to produce money?
Okay, so
That's what assets are.
yeah,
And then ROIC, which is return on invested capital, um, is multiple different interpretations of that. But the way that when I analyze, that's your return on the mixture of your debt and equity, which there's something called oh my God, what's it called? There's a name for it, and I just lost it. But like return on equity, return on assets, um, they're they're all correlated to each other. So basically, like return
it's
on
efficiency.
invested capital, yeah, it's all efficiency, and it's the DuPont formula. If you have two of the efficiency ratios, you can calculate the third, the
Okay,
DuPont equation. Yeah, ROE, ROA, and growth. Yeah, so it's the DuPont model. Yeah, that's what it is.
okay,
So these give you a rundown on how you don't have to go and calculate all these other ratios in order to find like return on assets and stuff. You can inverse them and multiply them with each other, and you will get the answers to all the other ones because they're all interrelated.
Okay. Okay. So so ROE is basically how efficient is the company at deploying the money that they're getting from their stocks. So for people investing in their company, how efficient are they with that money? And ROA or return on assets is how efficient are they with their equipment and their assets.
Yes.
Okay. All right. So ROE. Now, for comparison, these top two, UPS and Illinois Tool, their ROEs are pretty similar. Their current ratios are pretty similar, but the PE ratio of UPS is much lower, meaning that they're probably underpriced compared to ITW. But they're also in different industries. This is industrial machinery versus freighters. So
Yeah.
what's the next thing you look for?
Debt to equity ratio.
Okay, so debt to equity ratio. So what's MRQ as well for people that don't know this abbreviation?
I can't see the abbreviation.
This says debt to equity MRQ.
Oh, there it is.
I know YOY is year over growth, but MRQ is YOY.
I'm not sure. Is that a unit of like the timeline that they're?
I think so. Most recent quarter.
Yeah, that's what I thought.
Most recent quarter.
So it's showing the most recent quarter. Yeah. So, well, some other stock screeners I had, they would do it on an annual basis. So let's see what happens if, it should still be the same relatively, but let's do less than 0.5.
Okay, so below 0.5. So what is debt to equity ratio, and is big number better or small number better?
Small number, for sure.
So it's similar to current ratio. It's like current ratio, but it's the opposite. So
yeah, it's the capital structure of the business. So, all your assets are debits on your balance sheet, and your debt and your equity are credits. So assets equal debt plus equity. So really what you want to find is that you want a company that has a growing return on equity, and that has the debt at least half the amount of equity in the business, which means that if things were to go wrong, there's enough resources in the company in order to pay off that debt, and it's not over leveraged.
yeah. So current ratio basically looks at 1 year assets and debt, whereas debt ratio or debt to equity looks at anything beyond 1 year. Correct?
Well, no, neither one is specifically on any. So I guess this is one thing that needs to be explained. Like when you look at a company's balance sheet at any given point in time that you look at it, that is the snapshot of that's what it was right there at this time. Whereas you look at the income statement, if you're looking at it in December, that's an accumulation of everything from January to December.
Mm-hmm.
So like when you're looking at the balance sheet, unless you have a comparative balance sheet from a prior period, you're not going to be able to tell what any of the changes were. So the snapshot is just looking at, like, if you looked at, the most recent quarter and that's their balance sheet, like that's basically just where it stands in the health of the company right then as you see it. So as far as looking at timelines, I mean, you can look at, this is the most recent quarter balance sheet, but it's going to encompass everything that's happened before at any given point in time. So you want to say, what are they doing right now? What does the health of the company look like? And are their sales growing? Is there, return on equity growing, stuff, which is why you need all the other comparative statements.
We won't get into this, but we can go to balance sheets indicators and do like debt to equity ratio, which will bring up a indicator here. You can do the further analysis. So it's important to look at like what a company is doing over a long period of time. So if we use UPS, for example, you can see, well, it's kind of hard to see down here, but their debt to equity, they actually spiked up to 40 at one point. Now they're currently down to 1.4 on the debt to equity. So that's a pretty high extension of debt. Okay. So that's debt to equity, under 0.5. What do you look at after that?
Sales growth.
Okay.
typically like to do year-on-year sales growth, but if they have quarter to Q and Q or whatever.
So we got a lot of growth. Gross profits, free cash flow, net income, revenue.
Oh wow, they have free cash flow in here. That's cool. I wonder what
Yeah,
how they calculate that.
we've got free quarter over quarter growth, quarterly year over year growth, annual year over year growth.
There we go. Revenue trailing 12 months year-on-year growth.
Revenue trailing 12 months year over year growth. So what's the so go ahead and explain what's the difference between trailing 12 months TTM versus quarterly year over year growth?
Yeah, trailing 12 months means that from whatever month that those statements are published, and it's calculated a growth from the prior. So it'll be a year back from where you are. So if you're looking at, so say you're looking at financials in June and you're looking at trailing 12 month to get an annualized figure, that it'll run a fiscal year instead of a calendar year. So you're looking at revenue growth from June to June as opposed to December to December.
Okay.
And then year on year quarter is it'll compare quarter two last year to current two this year.
Okay. Wait, I thought I added that. Revenue trailing 12 months year over year, correct?
Yes.
Why is it not adding it?
It may not have those figures, possibly just because of the way that public companies release their.
Well, it should still add the indicator.
Oh, okay.
Revenue. There we go. That was weird. Okay. So higher numbers is better, I'm assuming.
Yes.
Okay. So it looks like one of the
Well,
best.
we got it narrowed down to what? What is that? 6?
Yeah,
That's good.
I'm gonna up the debt to equity ratio a little bit, just to see if we get. So when do you start finagling different numbers for like maybe bringing a company in with a higher revenue growth or something?
Well, it's actually kind of funny because normally I try to narrow it down to less than 10 and like playing with the numbers because it, normally creates a list of like 100, or 50. But I guess given the market dynamics, it has, well, in industrials at least, has really honed in on a top 10 stock list, really.
Yeah.
Like that JB Hunt transport service trucking, that makes a lot of sense. There definitely is catching my eye just on the pre-screener fundamentals that we've been scanning for.
JPHT. Oh, wait, what was the ticker? JBHT. Yeah, company looks very good on the
Yeah. It was like gone nothing but up. That's good Lord.
Okay.
So did they take a dip in 2008 as well?
Yeah, that's so I don't know if you guys can see the panel of you guys, but 2008 they went sideways mostly through the 90s.
Yeah, it looks like that. All right. So, well, that's a good thing to look at because well, hell, even starting in what, 2003, 2002, it looks like that's where they really started to launch.
They probably
from there. That's an important date to note because when you do research on this company, we want to look for if there was a management change, if they changed their service, and try to figure out what they did differently that helped them grow to the level that they did.
Okay, I'll just put a little mark there. They maybe got a contract or something, military. There's
good. Yeah, it could be government contracts. It could be numerous things. It could have been some vertical integration acquisitions they made, or it's hard to say until we mark it as something that we want to keep on a list to look into.
Okay.
And then we'll find more specifics as you open up the 10Ks and the 10Qs and do research and find out what the company's been up to.
Okay. All right.
And what exactly their service is as well.
What's the next metric we're looking at?
Well, if we go back to where we were, that's generally just the first couple like pre-screen stuff that I look at. So the ratios look good. So then the next step that I do is trying to debt interest coverage ratio.
Do you want to do free cash flow?
Free cash flow. Yeah, let's just see what happens. I'm afraid that it might get rid of a lot of them, or it might not. Who knows? But I would definitely like to see that.
So we got a few free cash flows. Price of free cash flow.
Just free cash flow.
Free cash flow margin. Trailing 12 months. FY.
Yeah. Do the what did we do for the revenue growth trailing 12 month? Right.
Yeah, trailing 12 months.
Yeah. So let's do the free cash flow trailing 12 month and try to keep them synonymous.
Margin or just free cash flow amount?
Just free cash flow. Well, I guess what does it mean by margin? Yeah.
We've got year over year growth as well. And then
yeah, let's do the growth. Yeah.
Yes, we want to. So the difference between, just to explain that to people, the difference between free cash flow, the difference between year over year growth and margin is essentially just a snapshot of what's happening right now as far as its free cash flow. But the year over year growth shows like overall health over a. Is it a 5 year? Isn't year over year 5 year typically?
Year over year is just one year.
Okay. All right. So that changes a lot. Packer has a 195% free cash flow. JP Hunt has nothing. So why would a company not have a free cash flow metric on here?
Well, I think that would be based on the scraping for the data, because every company has either positive or negative free cash flow. So it just wasn't disclosed or wasn't calculated.
Let's see if it has yeah, it doesn't have margin either.
I could calculate it, and the free cash flow, I have it in my spreadsheet models, but I don't remember I don't memorize the formula.
Yeah.
And there are multiple. Like it can be, man, I've seen like 5 different variations. Yeah, you're pulling it up right there.
It's operating profits after taxes minus investment during period of time. That's one calculation. Does anybody have any questions so far that's listening? Anybody not understanding anything or something that we might have talked about that you want more clarification on?
Well, I'll tell you why free cash flow is so important, because, you know, you can be analyzing a company and it shows that their bottom line is growing significantly. There are companies out there.
What's bottom line for those that don't know?
Net income. Sorry. So that's your after-tax income. If you're looking at private companies, it's basically income before taxes, because a lot of private companies are, LLCs, or, or some form of partnership, or LLP, or sole proprietorship, and they're all called an S corps, which are considered pass-through entities. So there is no corporate tax levied on those types of business structures. But for companies like this that are C corps, that would be your after-tax profit, because it accounts for the corporate tax that is imposed on the company. And those that don't know, C corps they go through something called double taxation, which means that as an entity, they get taxed on their profits. And if dividends go out to the stockholders or any of the owners, that gets taxed as well. And that's the double tax. So the entity pays tax, the individual pays tax when they get money from the entity. So you pay twice. Whereas an LLC or an S corp, essentially, if you don't have partnerships and don't deal with K1s, if you made $100,000 profit in your company, that goes into your personal tax return, and you'll get taxed based on your own marginal tax rate. So typically, C corps can be expensive on a tax standpoint. which is why LLCs are so popular, because they provide the protections from a C corp, but have all the benefits of taxes as a sole proprietor. But anyway, with free cash flow, and the whole reason I was saying this, free cash flow of the business is extremely important, and you want to see positive growth. Because I mean, if you see the free cash flow here on all these other companies and they're negative, they are losing money. Like that means that it's negative in cash. Now, doesn't necessarily mean it's all bad if they've been investing in capital expenditures, investing in other companies, and that's why their free cash flow is negative, because they've been spending a lot that they expect to get a return on. But your free cash flow is important to look at, and the net income of the company, because you can have a company saying we make $200 million a year in income, and then you look at their free cash flow and been like, you've made that much every year for the past 10 years, but you've also lost $1 million in cash every year since then as well. So, and that's why these balance sheet ratios are so important to look at. Because most people who, for whatever reason, that's a whole nother topic I'm not even going to get into. Most people aren't taught finance fundamentals. So a lot of people, when they look at stocks and go, oh, this company, the income statement's the one thing that everybody wants to look at. They want to know, oh, they made this much money, like we're good to go. But the balance sheet really shows the whole health of the company. I mean, it shows if they have any cash, if they own anything that's worth anything, especially with the debt, that can be extremely crippling to a business. So your free cash flow metric, all in all, will let you know if the company's actually generating cash or not.
Okay, so it's like it's not exactly profit, but it's like how efficient they are with their cash.
Well, it's how efficient they are with the business to generate cash.
Okay. Yeah. So let's say all these red here. Let's say that they are expanding. They are investing in bringing in acquisition and developing their company, and that's why their cash flow is trash right now. What would you look at next to kind of confirm that or measure that?
Yeah. You would want to do a comparison on the balance sheet. It would be hard to do it on a ratio unless you looked up like
maybe some kind of year-over-year growth, maybe. You got EBITDA,
no.
EPS diluted, net income, revenue, total debt.
EBITDA is the operating income of a company. So what that does is it adjusts for the financing part of like your cash flow statement. It's what it does is it removes interest from the income statement, and it removes, well, when I say removes, you take your bottom line and then you add. So this could get a little complicated with public companies. If you want your true EBITDA operating income and taxes were already taken out, you want to take your net income plus your taxes, plus your interest, plus your depreciation and amortization. And what that's going to do is show you what the operating profit of the company was prior to tax levies, interest from a bank or bonds or whatever, and depreciation from your long-term assets that you're depreciating over time. And that paints you the picture of like, this is our sales, cost of goods sold, here's all of our expenses, this is what we made.
So it's a very dry cut look at income, essentially.
I look at EBITDA all the time when I'm analyzing private companies. I found, and this is where we could really fall down into a rabbit hole. When you're looking at financials on these public companies and you're looking through the 10Ks and looking at their financial statements, one of the most important things that you have to read are the footnotes that they have explanations underneath the financial statements, letting you know why they recorded things the way that they did, because a lot of them can be very deceiving. Like they could, net income could show that they made $500 million more than they did last year. And then there'll be like a little footnote asterisk on the statement that goes, this is because we sold a property, but they left it in there. And, or we sold a bunch of our warehouses, and those are called, that's a one-time event, or those are earnings. Like if they made a gain on selling off a bunch of property that now they're not going to be utilizing to make money anymore, but it gave them a big spike in their income, that's a one-time event. You want to adjust for that because that's only going to happen one time over, a period of years. So you want to,
wouldn't you see a drop in their balance sheet?
Really hone in on the fundamental business operations, which is this business sustainable? Is it going to produce cash, and is it going to grow?
Yeah. So okay. So EBITDA is a great way to look into that, or that the rabbit hole starts with EBITDA on that.
Yeah, and that's where a big misconception comes too. A lot of people think EBITDA is your free cash flow, but it's not. It does not account for your change in net working capital. And depending. No, I mean, really, in all, it doesn't account for if you spend $100 million for a new million square foot warehouse or anything, and that's where free cash flow comes in and lets you know where money went in, what money came out, which is a extremely important figure. So I know I'm kind of going on tangents here, but
It's okay. It's okay. Okay. So where do you want to go from here on this?
well, how many companies are up right now? 22.
22. Yep.
All right, but we have 4 that are in positive free cash flow. What happened to the other one that had 0?
It's down here.
It's all the way at the bottom.
Yeah, let me flip it around.
That's interesting. Why don't you do it by revenue growth? Yeah.
There you go. JB
There it is. Yeah, that's something that be a good lesson to learn of how to calculate it yourself. But we'd have to calculate that one ourselves. Oh, wait a minute. Your current ratio is set below 1.5, not above 1.5.
Oh, whoops. Good catch on that. That's probably important.
That's going to change all of these.
That's going to change a lot.
Yeah, because I looked at that company and I was like, wow, that's really interesting. And I'm like, oh, wait, they're under 1.5, but 1.38, that's not.
Yeah, I was wondering why there was so many red free cash flow.
Yeah.
This is
there's the company.
better.
What's that?
All right. What do you want to sort by? You want to sort by free cash flow, revenue?
We'll leave it where it is there right now.
Okay.
So yeah, if we do it by free cash flow and we bring up that other one that's at 0 just because it wasn't calculated.
This one looks awesome. Expeditors International of Washington.
Yeah, I see that. Oh, they're an air freight carrier. 17 billion market cap.
I heard something that was happening with air freighters out of Canada or Alaska or something.
Yeah.
There was some kind of innovation. There's something that happened on the routes to like Asia or Europe through Alaska, Anchorage or something. I can't remember what it was.
Yeah, interesting. That would be one I'd be interested in looking at for sure. It looks like pretty strong. Even same with that. What is that?
Which one?
Packer Inc.
Packer?
Packer?
Trucking, construction, farming. Farming machinery. Packer. Their all-time chart looks 14, pretty good.
14. Oh yeah, because they were from 1973. Holy shit.
Yeah, I think Packer's I've seen Packer around.
Yeah, that's right. Industrials is a boring sector, but it's extremely important for the economy. These what makes the world go round here. Yeah, I would say let's filter out. Let's see.
You want to do revenue growth?
Yeah, do revenue. You're at below again, just FYI.
We want
Let's
shitty.
Do how I don't know. 10%.
That reduces it a bit.
All right, and then let's get rid of these gigantic negative free cash flow people. I'm just kidding. We'd have to look into what they actually are, but I say this would be a good starting list. I was at 14. Let's try to get it down to 10. So if we could,
let's drop maybe the debt. Well, Packer's got really good cash flow though for its debt.
Yeah, I'd be interested with their debt. Actually, is the debt interest coverage ratio on there?
debt interest coverage.
Yeah.
Nope. How do you, is it got an abbreviation?
DSCR.
Nope.
Okay.
Let me go into filters here. Financials.
We could do quick ratio.
Okay. Now, so what's the difference between quick ratio and current ratio?
Well, they're very similar in the sense that you are comparing your current assets to your current liabilities, but the quick ratio accounts for inventory, which is considered your most illiquid current asset. So like anything on the balance sheet that's listed as current asset or current liability means that it's going to be used up in a year or paid within a year. And that's why there's a difference between, like short-term debt and long-term debt. Long-term debt is any debt that will be repaid at a time length farther than a year from now. The same with current assets. But the thing is, inventory is a current asset on your balance sheet. But some of that stuff could have been sitting there for 20 years in your inventory.
Yep.
So what that does is it takes your current asset minus the inventory divided by current liabilities. So it gets rid of your most illiquid current asset, and which can really change the picture for a lot of people as far as the
Yeah, because
health of the company.
it's hard to liquidate inventory quickly, especially if like a recession or something happens or something.
Yeah, like shit hits the fan. To get rid of all your inventory is a monster beast of a task.
What kind of quick ratio above what?
Uh, let's see what happens if you put in 1 for now. Okay, that's not bad.
Looks like we got Old Dominion, Fastenal, Packer, Expedited International. I think this is a decent list.
Yeah, I think it's a decent list too.
Okay.
So this is where I would pre-screen. I would find a handful of stocks just like this, and then from here, the fundamental analysis stage, where all the hard work comes in, is then you have to go in and do your analysis on these companies. And sometimes it's better to filter for what you understand best. So, if you look at some of them and you read, what they do and you don't understand that business, but there's another one that you do understand, it's best to go with something that you do understand. Because that way, when you're analyzing the company and they're telling you about their growth strategies and stuff and their 10K, you can actually make some sort of an opinion based on it. Because if someone's talking about, to me, artificial intelligence and how it's gonna delve into your expertise, Garen, in the cryptocurrency market, and how you have these decentralized banks going, all that kind of stuff. I would leave that one go because I don't understand the intricacies of all that stuff. Clearly, I don't even know the right terms. Like I'm just like.
First thing I'm going to do is throw this into a. So since these companies they look relatively sound fundamentally, I'm going to do a 30-day RSI and just dip by the bottom two. So these are companies that I theorize are going to perform well over a long period of time. And the first thing I always do when I'm fundamental screening is just look at their charts. Your chart will tell you if a company's good or not. So like if the fundamentals come back and they look good, but then you look at the chart and it's just been declining for 5 years, something's wrong. So all these companies seem to be pretty old. That's another thing. Most of them date back to 1980s, which is another good thing from my perspective. ODFL, and feel free to disagree with me at any time, Jesse, or why I might be wrong.
Well, the only thing that, you do have a very good point that if you look at the charts and, you've seen they've been declining for 5 years, it can mean that there's something wrong. But if you go through a thorough fundamental analysis and that regardless of the stock price, that this company is absolutely killing it, that's going to be one of those sort of black swan events eventually that will spike up, because fundamentally the health of a company is how well they operate and how much revenue they're generating, separate from the stock price, like that's traded on the market. So with that being said, there are companies out there, like that's how I automated the returns when I was stock trading, because when the PE ratios are low and there was like a decline and you see how strong they are and you go through and look at who their management is, you know, how they stack up to their competitors, what they're doing now to grab market share. Those are the types of companies that will give you those large returns in a long-term horizon, simply because of any sort of Wall Street manipulation, you know, or you just have a lot of people just shorting a company because for whatever reason, or
Yeah,
like
that's
the
probably
CEO,
another.
or the CEO said something racist, or like in a video, and everyone's like shorting the stock. You know what I mean? Or
I'm
just
surprised they won't let me sort by short ratio. That's a indicator that I look at on a technical side a lot, a short ratio.
no, I
Uh,
never heard of short ratio.
it's essentially what percentage of the
Oh,
float.
I got you. On the float, you mean how many shares have been borrowed for shorting?
Yeah.
Yeah. Okay.
Cash and short-term investments. I'm surprised I don't have short ratio on here. It's like a pretty critical indicator. Let's see on the technical side. Yeah, they don't have short ratio on here. Interesting. So one thing, as I was cycling through these charts, the IEX, this is the chart that kind of concerns me on a technical perspective, because it was flat for a while from its starting point, 2018, and then it kicked off during the start of COVID, just after COVID. This is Indian Energy Exchange, which is kind of at the bottom
Are
of
they
the
on
list
the
here.
screener?
Industrial machinery, their market cap is
Wait.
18 billion. Volume is pretty low, 100 million. IDEX Corporation.
Oh shit. Yeah, you changed the PE ratio to 45. That makes sense.
Yeah. I increased it a bit. Looks like they pay a dividend. Earnings have been increasing, revenue's been increasing, cash flow.
Well, that's cash flow from operating activities, cash flow from investing, cash flow from financing. So looked in 2021, they spent a lot on investing. That's the purple line there.
800 million investing.
Financing, negative. We're at zero.
So they invested a lot. That might be why their stock chart has dipped since then.
Yeah, cash flow from investing went negative, which means that they spent a good chunk of money. It looks like 800, like $700 million is what that looks like.
Investing 700 million, 698 million.
Wow.
Let's look at their statements.
Could that be paying back investors?
It could be.
So it looks like their assets are increasing at a faster rate than their liabilities, it looks like.
Yeah.
12%, 20%.
So total debt 1.3 billion. What's the net debt figure?
Net debt. That's a good question. Let me go back
That
to
like less the current portion or something?
net debt is the amount of debt that would remain after company has paid off as such debt as possible with its liquid assets.
Okay.
Financial measure. Statistics. Annual price to earnings ratio, price to cash flow ratio.
Wait, now that I think about it, someone who asked that question It just hit me. If the dividends were paid out, that would have showed up in financing activities. Do they have a balance sheet?
Yep. I'm gonna look at their dividends real quick because dividends per share, dividend yield, dividends increasing. Well, at least they're increasing their dividends per share, so they are increasing their payouts, even though their price is going up. So their dividends
Yeah.
are. So balance sheets, statements, balance sheet. What do you want to look at? We can do income, balance sheet, cash flow.
Yeah. Do open up total assets and total assets and total liabilities.
What do you want?
Just keep opening them all up.
All of them?
Yeah. All right.
This is quarter over quarter. Do you want yearly?
Do they have? Yeah.
2015 to now.
All right. So let's look at. So do notes receivable. All right. So from 2020 to 2021, was that another 50 million?
Which line item?
invested? I'm looking down at the long-term investments. Well, net property, plant, and equipment.
So they did about 34 million.
Now that's their net, but their gross amount. See,
Yep.
the net amount is their fixed assets minus accumulated depreciation. So when you look at you want to look at the gross there, and that will tell you what they actually spent the money on, and the rest is non-cash write-offs and depreciation that they spread over the life of the fixed asset.
Okay, so there was about 40 million, no, 50 million that they put in.
Yeah, so that's really interesting. Open up the cash flow statement.
Looks like it went here, machinery and equipment. Actually, can you see the item? I think you can see the individual chart on these too. Yeah. Wow, I've never gotten this deep into trading views.
Yeah, it's actually kind of nice.
Yeah. So you said cash flow or income?
Cash flow. Or go to investing activities.
Sales.
Capital expenditures for right now.
Big jump right there. That's quarterly. So
That's Q3. So, but
yeah.
the trailing 12 months, they spent 75 million on fixed assets. There's only 200K. Where's that 800 million dollars coming from in their investing activities that showed on that chart? I don't know how the trading view thing. I mean, this is kind of nice. I don't know how accurate it is. And there's your free cash flow at the bottom. So that's interesting. If you open up the cash from financing activities, you'll probably see the dividend payouts and you'll see how much they paid out in total. 173 million in past 12 months. They spent out, like, give out in dividends.
So what are you seeing from this analysis so far as to why maybe they had this big dip? They're down 50% or so right now.
Yeah, I don't know. It's hard to say. What can you you had the income statement earlier with the quarterly data. Can you pull up the annual for that?
Yep. What do you want to look at? Oh, we got 11 people in here.
You know, I don't know why their stock price is falling. Might be some news or something that was disclosed.
Let's see. Forecast ideas news. Let's see. Acquisition of Muon Group, September, October. Deployment continues. So the dip, I mean, obviously the dip started during this last downturn, so November. September, June.
Might be a heavy reliance on supply chain. Can we
So they bought Muon Group.
yeah, I don't know. Look up IDEX Corporation and look for their 10K. I want to find out what are they actually doing?
Okay.
They're manufacturing something it looked like. They had work in process, raw materials and stuff on their inventory on their balance sheet. So
IDEX 10Q. So this is since we've got coders in here, everybody that's codes in here, me and Jesse were talking about scraping 10Qs for very specific information and data. Quarterly findings. You want to look at the quarterly?
yeah, that's fine. Yeah, open one of those, like open up a PDF.
This is October 26th. The acquisition happened in November.
Yeah, what's that? October, November, December. They won't be releasing probably for another month.
All right, what do you want to look at?
Just keep scrolling down.
Yep. You got 102 pages.
Yeah, so it's all financial. Let's look at. Okay, go down. You see management discussion and analysis of financial condition and results of operation. So IDEX is an applied solutions company specializing in the manufacture of fluid and metering technologies, health and science technologies, and fire.
They make a lot of pumps and things like that. They have three
Okay.
divisions. One of them is fluid and metering, one is health and science, and one is fire and safety.
Okay.
The health and science is more lab scale pumps and things like that. Fluid and metering is going to be more industrial scale, and then fire and safety is going to be targeted on like firefighting pumps and foam systems.
You work in oil and gas, right, Aaron?
I do actually have a friend that works for this company, but I don't know them that well.
Okay.
Interesting.
So what are you hunting for right here? Just trying to.
I'm just scrolling through and seeing everything that they're disclosing, but they're showing a lot of growth in everything.
I think it's just a mispricing in the stock price, just public perception.
Probably.
So
That would be a good candidate. We scroll down a little more? Obviously, I would spend a lot more time before
Yeah.
I would buy something like this, but I mean, how they're even increasing their gross margin, like operating next. Huh. Gain on sale. So they sold. Okay. All right. Keep scrolling down. You're going to see the risk factors that they have to. See, here's all the stuff they'll disclose on some of those line items on the financial statement. Restructuring is best to increase both in 3 and ending. Oh, so what in September, they had an asset impairment related to the exit of a COVID-19 testing application. Let's see.
what's an asset impairment?
Well, typically that would be hold on one sec, I'm still reading. Interesting. An asset impairment would be like a write-off from your balance sheet because something went wrong. Like I mean, it could be anything from like your warehouse catching on fire and being destroyed to well, apparently these people, they were doing some COVID-19 testing application thing and probably spent a lot of money building that up to go to market. And then it failed. So it's written off as impairment.
That might be the news. That could be a news driver on the public perception side that could drive.
When did it start dropping a lot more? Go back to oh, look, it's September.
Yeah.
If you go back to, oh no, that was September 22.
Right here. I mean, it still
Yeah.
dipped down. It broke its this range. It looks small, but that's a 16% drop. I've got it on logarithmic.
Yeah, interesting.
I mean, it's got a great technical base. This is a solid. This would be a great swing trade. On
It looks like that spike also could have been from that huge rally that happened.
Yeah, I'm guessing this probably has
over a year
a low float too. This has a lot of volatility in its price movement.
Hey guys.
Yeah.
One thing I noticed, the IEX you have in there might be the wrong one. That is Indian Energy
Oh, we look.
Company versus
We're not
the
even looking
IE.
at the right chart. Way to go, Garen.
Yeah, this looks better. This looks better.
Go.
And
I still like that chart. That other chart looks good.
I was just like, I don't understand why it's just falling so bad. Okay. Oh shit.
Okay.
I was looking at the IDEX chart and I was like, what are they looking at? Like, what's this drop they're talking about?
Thank God for you. Well, it's a good thing this isn't a YouTube live, Garen, and you know I'm not the type of person who's very good in front of a camera. So we're over here analyzing the wrong technical stock chart.
Well, that solves that. Okay, so the next thing I'm going to do is I'm just going to add all these assets to. Can somebody? Can you guys read off real quick? Just these. I'm going to post it in the. I'll post it in the Discord.
Actually, I don't have my Discord open, so I don't know if I'm going to be able to help you with this.
Somebody in lead chat, can you just read those off to me? I'm going to add them into the symphony. I know the first one's PCAR. EXPD. ODFL. Fast. CPRT.
IEX.
AX.
And I can't remember the last one.
AOS. All right, so we're just going to buy let's do bottom three just to give it a little bit of diversity. 30 split. Looks pretty good so far. Back to 2016. 25% annualized, 35% drawdown. This is where I'd start finagling stuff. I'm doing maybe bottom two. %, 33% drawdown, so that's a bit better. Try out a calendar, like a weekly rotation. 26, 36. Do a monthly. 24, 35. Seems like just the threshold, the best. Leave it at. I usually do 7% threshold. I also like to test out different time ranges. This is kind of overfitting at this point, but 34, 29%. So it seems to perform better on a faster length. Let's see what the 10-day does. 22%, 37, so that's not good. Looks like 20-day. I'll do a 60-day, which is 3 months. Look back.
60, that's 2 months.
No, it's 20 trading days per month.
Oh, okay, gotcha.
So 3 month looks good as well. So it's a 32% annualized and a 31% drawdown. What we can do is this can be like one rebalancer. I'll basically duplicate this a few times. 33%. So that's a really good one. 33% with a 26% drawdown. So dip buying on a 6-month period. So the 20-day, the 60-day, and the so we'll do RSI 20, 60, 126, 6-month. I'll test 1 year just to see. 256. I think it's 252 actually. It's 1 year. That one doesn't do too well. Okay, so now we will switch this to cumulative returns. Not current price, current cumulative returns. Bottom two. 20%, 29%, not the greatest. Do top. So I find that doing top on a longer window of cumulative returns, well, it does pretty well during the bull run, but during the bear market, it sucks.
Not so good.
Yeah. That's what relative strength index is better in overall market conditions or market regimes. RSI typically does better because it's a ratio chart, so it's a bit easier to compare assets on a ratio versus cumulative returns, especially on the longer time frames, because some assets can have like a fucking 50 or 100% CR over a year. Wait, let's do top 20, and I'll change this down to 10-day. Actually, let's start with 5-day CR. Yeah, it doesn't look too good. 10-day. Better. 20-day. %. It's doing better the longer the time frame on the CR, but it's not anything great. Do a month and a half, and then we'll do 6 months, or not 6 months, but all right, that's a terrible one. So it looks like CR is not doing too well. 3-month look back. Not bad until the bear market. And then the last one will be the 6-month look back, which isn't too bad. Okay, so now we'll go back to the RSI 20. Do bottom two. I'm going to duplicate this, copy, group 20-day RSI. Delete this. $60-day.
Is that RSI?
It is not. Good call. All right, just to blend them all. And now we have an industrials sorter.
Yeah, which is pretty cool. I wish there was a way to, because I guess with the individual stocks, you have to like put them into your own ETF or something. If we could find a way of like, because generally I would probably only choose one or two of those companies that we were looking at, and then do the same thing in other sectors, and then you know what I mean, like build up that portfolio that way. Is there a way that Composer can encapsulate that sort of, like a portfolio strategy?
Yeah. So what I typically do is I like to segment out. I like to take the individual. I'll save this and I'll track this specific strategy to see how it performs out of sample. But
Yeah.
I'll take this and I'll throw it into one of our more advanced strategies, like QLED for the long term, for example. I can hop in here to a strategy I know has been performing really well over the past 200 and something days. QLED, which has I think it's done like 70% in almost 9 months or something.
Wow.
So I can come in here and just copy to draft. And then I will use this as like the framework for this overarching strategy. So looking at this code, it works really well during this bull market. And it still does pretty well during the bear market. But I can come in here and open up QLED for the long term. And then right here is the normal market code. If I run this right now, it does that. Let me add a benchmark. I'll just add the default QLED for the long term. And then we'll delete, actually, yeah, we'll delete this. Paste it. And now it will run that during the bull market, and then it's short code during the bear market. Doesn't perform much better because this is industrials, though, because industrials isn't going to be super bullish. But
Yeah.
I can add it down on the bull side of the short code. And it'll probably also work better with a rebalancer. So if I balance this with like technology or something, it might perform better.
Okay.
Okay, didn't go good there. I can add it in as a 50-50 split with the short code, which probably won't perform well. But basically, this is just creating like a block for diversification. So yeah.
Okay.
Reduce the volatility, it looks like. The drawdown, yeah, the max drawdown is better. Annualized return is dropped. But yeah, it actually has a higher Calmer ratio because the max drawdown is lower. So it is helping with rebalancing, but you probably want to weight this as a specific, just to get that annualized return back, but maybe like a 70. Let's do like a 85-15. So we'll get that APY back, but we should have a better drawdown. A little bit better, not much, but yeah, that's that. So okay. Well, from that, you got to get going, Jesse. How long have we been going?
Yeah. Yeah, I'm gonna have to get going here soon.
Okay. All right. Well, thanks for showing us. Is there anything else you want to touch on real quick or talk about? Anything important? Anybody have any questions?
I can't think of anything for myself specific other than well, I guess that this is the method that we did today is just kind of like the quick synopsis to filter down stocks and stuff. I would say that if anyone has any interest in fundamental analysis and really dig down a lot deeper into what I would call my world, I can happy to do that at some point in time. And really deep dive into something and how to run analysis, probably even pull out my calculator or something. But
yeah, and if any of you guys aren't in the A51 Discord. I made a little channel for him too, Jesse Training. So if you have any specific questions for Jesse on fundamental analysis, you can shoot it here, and he'll get back to you when he can. Just efficiency wise, it's better for time. I went ahead and switched the sector to energy, S&P 500 energy.
Okay.
It's doing a lot of these companies look really good as far as free cash flow and revenue. 2,000%.
Oh yeah.
Marathon Petroleum free cash flow.
Wow. What is a quick?
Yeah, it's a big
Yeah, they
discrepancy.
do. They do look pretty good there, but then we have, wow, these PE ratios are all at like 5. Wow, that's crazy.
It's because no one wants to invest in oil right now because of the ESG concerns, is what I
Right.
think.
Makes a lot of sense. Yeah, I was gonna say, is this like a recent I would say PE just recently dropped based on all the news?
My
Just out of
experience is,
curiosity, just to pull it up. I'm just like to see.
well, there was a really big downturn in 2014, and it really hasn't recovered with, that and COVID and everything else.
Okay. Interesting. I never heard of them before. Marathon Petroleum Corporation.
Bunch of gas stations.
Well, there's 2 marathons.
Well,
there's
there's-
Marathon Oil and then Marathon Petroleum.
Yeah, Marathon Petroleum is the refining division.
Okay. So can you give me a rundown on the ESG stuff? I've heard of it. I know that there's legislation and stuff on it, but how
Well,
exactly?
I mean, really, it's a lot of investment firms, let's say BlackRock or whatever, they don't want to invest in oil. And they've flat out said it. And, a lot of ETFs are getting rid of it. There's just a lot of negativity in the investment circles. And so it's all having to come through smaller private firms to get money into the industry.
Okay.
Interesting. I
Based.
know oil and gas is well, that's where some of the oldest money in the United States comes from.
Yeah.
Oil and gas tycoons. The one bank that I actually bank with, and the one company I own in Oklahoma, they how the president of the company and leader of the board, he's only like 26 years old because he was the son of the father, and they're all in land rights for mineral mining out there and for gas as well. I think natural gas and stuff, but they have owned like billions of dollars worth of stuff. It's like crazy.
Is that what you were doing in Dallas a couple weekends ago?
No, that wasn't in Dallas. The bank I'm talking about right now is in Oklahoma.
Oh, okay.
Dallas was for boring equestrian distribution stuff.
I know everything I've been studying with Peter Zahan. He's very bullish on energy throughout the world because like everybody's trying to go green, but he's arguing that we just don't have the technology and we don't have the output to do it. Like we don't have the technology to really turn.
Didn't you you're the one who sent me that video, didn't you? About
I send you a lot of videos.
You do send me a lot of videos. It was the one where the guy was talking about how the United States efforts in reducing will go in environmentally friendly and everything. And they said if on a global scale, and there was this huge economic study showing that if we went full green in the US, it'd only change 2% of the pollutant output in the world. And it's all coming from the countries that are kind of going through their industrial revolution, like India and China.
Yeah.
And he was saying, like, what is the point of us doing this? Because they don't give a shit. Like they're not going to listen to what we're saying. And he was like, ours is such a minimal impact, but it's all coming from overseas kind of thing. So I think energy is still probably going to be a very profitable industry for years to come.
Apparently, I wish Divanish was in here. He's my editor, and he's from India. He lives in Bangladesh, but I just read or heard something that India, the majority of their energy comes from wood burning. They actually fucking deforest and burn wood for their power plants.
Really?
They don't have coal, and per volume and per BTU, like wood is way worse coal wise, or like carbon emission wise, than coal is. And there's also grades of coal. So like Russian coal, I think, is the shittiest coal or something. Oil, and then there's different levels of coal. And then Germany used to actually have efficient per BTU and per pound, their oil or whatever energy they were using before they basically said no more, was actually better than the energy that they're now sourcing from Russia. so Germany's cleaner on their books, but they're actually producing more carbon emissions because they're using shittier versions of oil or worse processes.
Wow.
So in my opinion, the only way to really reduce carbon emissions is through nuclear power.
Yeah, that's basically what I've come to the conclusion of.
Yeah, I agree too.
And there's a movie that's out about that
forms
that just came out.
Yeah.
Have you guys seen the thorium reactors? There's a new reactor type that's been well, it's not new, but it's being experimented with because it's much more stable than the other radioactive levels.
As far as I've seen, they still haven't solved the fundamental materials problems with the extremely caustic fluoride salts at high temperatures that are just incredibly caustic over time. But someday there's lots of thorium, so that would be great.
Yeah, wasn't that? Yeah, they had an issue of like their pipes, like the salts or whatever they were using was literally eating through the pipes.
Yeah, over time. Yeah, FLIBE, their fluoride. I forget the full mix, but it's nasty stuff.
Wow.
If you ever want to see some nasty refinement too, look into oil or aluminum refiners. Like they basically have, in order to refine aluminum or alumina out of the earth, you basically have to drop alumina into a vat of acid and crank it up to like 2,300 degrees Fahrenheit.
Jeez. I didn't know any of this.
Yeah. Aluminum's a bitch. The refinement processes, they have these gigantic fucking electrodes that are like the size of a bus. They drop them down into a vat and they let them sit there for a week while they shoot them with. Not only do they have to do that, they have to run like 1 billion volts and 100,000 amps of current through it for a week straight just to break apart the molecular bonds of the oxygen and aluminum. But all right, man, it was thank you for jumping on here and taking the time to show us all this. I'm glad.
Yeah, for sure. Yeah, thanks
like
for having me. And if anyone has any questions or anything, shoot them over. I feel I'm much better in a non-public setting. So.
It looks like you got 5 hours of sleep today too, instead of the usual 3.
I got a little more sleep. I woke up early. I actually, because of these like investor meetings and stuff that I'm doing, I worked way more than I wanted to today. Put in like a full probably 8 or 9 hours. So.
All right. Well, for everybody that's in here, I will, if you need an invite to that Discord, let me know. And then I will, I'll take a screenshot of all of the sectors with this current criteria. So that way you guys can look through it if you want to do individual sector stuff. But all right, I'm going to kill the recording.